I asked the question about red flags. What are some things that we can be, looking for? And Kathleen, you mentioned that Dave Curtin is going to have some great insights on that. And he's working as a Dno underwriter, directors and officers type insurance, management liability, that kind of stuff. So he, I'm sure, will have some real-world examples of some red flags. On that point, and since we do have, 10 minutes or so before Dave joins us, let me go ahead and escape out of this. And you got me thinking a little bit overnight about this idea of clues into potential issues at companies. And we did have, the person that asked the question referred to the article that we had you read as a pre-read, which was Tread Lightly Through These Accounting Minefields. And I highly recommend, as I said before, that article. Some great ones in there, things to look out for. We talked about a couple other ones at the end of the day yesterday. We talked about goodwill impairment. That's a huge one going on real time right now. We talked about going concern concerns that are, it's just huge right now as companies run into problems. We talked too about derivatives. If you're carrying assets on your balance sheet, invested assets, hey, I would like to know what you're investing in, especially if I'm a shareholder or if I'm analyzing your company. Because there are investments and there are investments. We just talked about in kind of the fun poll, junk bonds. Well, that's an investment, but frankly, be careful when you're into those triple B, double B, and down, because you're carrying a lot of risk, or more risk at least, of something that's higher rated. So with those, we added a few to the kind of list in the HBR article that you have, but I did some thinking last night and put a few more that came to my mind. This is by no means an exhaustive list of any kind, but it's just a few that I've actually seen in real life. Sorry, next. Oh, I thought I heard someone speaking.
No, it wasn't me. I think
okay.
Somebody has just joined.
Oh, great. Okay, thanks. So, yeah, I think during the intro I mentioned I was in consulting for a number of years, working with companies. I worked at Deloitte & Touche Consulting Group, now known as Deloitte. I worked at Mitchell Madison. I worked at SPSS, and there were a few things that I saw in our customer engagements, and those partly fueled the list that I'm showing you on the screen. And Max, is the list showing up with red flags?
Yes.
Excellent. Yeah, so beware, some troubling clues to watch for. Let's go through a couple of these because I have a few kind of real world examples of a couple of these that I found very interesting. So, but let's go through them. We'll make this available as a downloadable PDF, again, on the interactive agenda. But, the first one, obviously, if you see revenue, profit, or retained earnings on the balance sheet, hopefully watch the video about financial statements. Understand retained earnings represents profitability that we've accumulated over time. Even if we have a negative profit, it goes into retained earnings. So if you see that dropping, could be an issue. Revenue and profits. The list is almost endless, but just a few things you might want to think about. If you see those trends, are sales lagging? And that's a problem because people aren't buying the products. That obviously is a red flag. Costs rising, and why? That's reflected in return on sales, which are profit margins, return on assets. Is your profit dropping, but you still have all these assets you're having to manage? That would give you a lower return on assets metric, and that's obviously a troublesome sign. And I made the point over time, and I should have also added, and compared to the industry benchmarks, because that really is how you can, and we talked about this in the video about metrics, but, thinking about how companies compare to industry benchmarks is a great way to start thinking about some red flags too. So industry comparisons. The next one, working capital. Working capital is really focuses a lot on the assets, current assets that you have, the accounts receivable, the inventories, and your current liabilities and some things that you're having to pay out, like payments to suppliers, payments on short-term debt. And some of the issues, I'm just kind of getting through a few of the ideas that I have in this. One to look out for is accounts receivable too high. You can also add to that accounts payable too high? I kind of note that in the implications. But if your receivables are too high relatively, and again, you got to think about what you're comparing this number to. Past performance, industry averages. Could mean the customers aren't paying you. You're extending credit to them, but they're not actually paying you. That's a problem, because eventually you got to write up those receivables. The other one is not paying suppliers. You get away with that for a while, but after a while they get very unfriendly about not being paid. And they'll stop delivering stuff. That puts companies out of businesses, I can tell you for sure. I had run into a cabinet company, right? A small business making cabinets, had a real issue with collecting from customers and paying suppliers. You know, the idea is I got customers here, they need to pay me cash. I got suppliers over here, I need to pay them cash. I need to collect from the customers so I have the cash in the company to pay the suppliers. That's what working capital is about. If that gets out of sync, I'm in serious trouble. It puts small companies especially out of business all the time. You read about construction companies, you know, restaurants, small businesses that don't collect from customers before, so they have the cash, before they pay the suppliers. Real problem to look out for. Inventories, obviously, if inventories are too high, customers not buying your product. That's bad news. Cash flow. A couple of things, and Max, you and I were talking about this a little bit this morning too. But if you see fluctuations up or down in cash flow that are unusual, that could be a real red flag. And you think, well, I understand cash flow dropping, that sounds like an issue. You know what, not always. Because what if you're actually investing in some important capital expenditures? So there could be a reason. You got to go that second level thinking, third level when you're looking at cash flows for sure. And that's why it's so important to at least broadly understand a cash flow statement. But if you see fluctuations, you know, some downs, or a problem with operating cash flow, you know, we want to look into that. You want to have enough cash to pay through your operations, but also have enough to do things like invest in the business, pay a dividend, repurchase stock, things like that. And that concept is called free cash flow. I think I have a slide in that in one of the videos. If you see big delays in capital spending, that could indicate a problem with cash. Hey, we're going to put off in this necessary infrastructure maintenance or purchase. That's a problem. That catches up with you. Some real-world examples. 3G is an investment company that goes out, invests, and kind of takes at least some level of control over the companies that they invest in, because they invest a lot. And they tend to try to cut capital expenditures and just beat the heck out of the company, get the most out of it in the short term. The problem is that catches up with you. Over the long term, you have to have the machinery, the plant, you have to maintain that stuff. You can't delay it. So be watching for that. The other one is, you know, you think, well, hold it. Cash flow went up for that company. There was a big infusion of cash. That's a good thing. Not always. Because you need to ask, where's the cash coming from? Does it mean you're borrowing all that cash? Or did you issue a bunch of equity? That will build cash. But now I got to pay interest on the debt. I got shareholders. I've diluted, you know, the stock price, whatever, right? There are second order problems that could come out of that, or implications. The other one is, hey, and this is sort of the 3G, and you can look up this company, very interesting, investment company. You know, they can raise cash flow, and they do this, but other companies do it as well, by selling assets. If I have 5 plants, I could sell one of those plants, and cash suddenly goes up. And if you're not looking for that, you might think, oh, cash is up, everything's good, but maybe it's not. Maybe selling that plant was an emergency move because we have some problems. All right. I'm going to speed up a little bit to make sure I get through these before we have Dave Curtin on the line. Revolving credit. I did a consulting project with a large home builder. The reason they called us in, they had to draw on their revolving line of credit. That's bad news. Their stock price had a tremendous drop because they had done that. So they called in the consulting company I was at to come to work with them to get through the problem. Auditors, I mentioned going concern concerns. If you see a company switching auditors, that could be a red flag. Not always, but again, these things to think about. If you're switching auditors, especially a lot, why are you trying to hide some bad news? Changes in accounting methods. Are you changing things to make your numbers look better? Is solvency still in good shape? Management. You have a lot of people quitting in the management team because they're abandoning the ship. Or, and I've seen this too in one of the consulting companies, smaller ones that I worked at. We were living high, spending lots of money, and the problem was you too much of that extravagance in the expenses, and you're going to be able to see this as you look through the financial statements. You see a lot of extravagance. Maybe people are living too higher than they should be given what's really going on at the company. Especially for small businesses, that could be a death knell. Legal actions, obviously, if you see some lawsuits, you got potential problems. Here's an interesting one. Strategy shifts, right? We talked about missions, objectives, strategies. You see a company whipsawing and just changing course constantly, abruptly, unexpectedly. That could be a sign that they're just they're trying things, right? They have an emergency, trying to get out of it. Next one, rating agencies. We had the little video about Moody's and S&P and Fitch. If you're seeing downgrades, obviously that could be an issue. Access to capital is one of the big ones. Companies who get downgraded, including the USA back in 2011, as I had in the video. When you get downgraded, it's harder to access capital and get loans and issue bonds. Final one, because this is kind of an interesting one, and then I'll wrap it up. SEC, Securities and Exchange Commission investigations. Obviously, if you're being investigated by the government, that could be a red flag. And there's actually you can go out to the SEC's website and you can see the violations. They have a list of it. I mean, it's all public information. And so I happened to be out there just for fun last night looking at their kind of list, and it's a very long list, but in the top three, at least in the kind of search I was doing, you'll never guess what company came up as a violation. Moody's. Of all the companies, I never would have expected that, but yeah, Moody's, the rating agency, is actually being investigated by the SEC for, and I forget the exact violation. It's not something just terrible, but it's interesting because in the video I talked about how these rating agencies are being, questioned in terms of their true impartiality. So they're being investigated for a statistical method they're using that seems to be in violation of some provision. So very interesting. You can access and take a look up your company, whatever company you're analyzing, and see if they have any SEC investigations on them. With that, we'll make this available to you. Kathleen, do we have Dave?
Yeah, it looks like we do. Go ahead, Jeff.
I am here. This is Dave.
Excellent. So, Kathleen, did you want to introduce Dave, or were you going to do that, Dave?
I think that Dave has yeah, I think he had a few slides that he wanted to share. Are we able to get that up next? They're showing now.
I am going to make you.
Okay. And then
You should see at the bottom of the screen a button appearing anytime soon.
So, Max, I'm still seeing you.
yeah,
Come up now.
There we go. Got it.
Yep.
Okay.
All right.
Does everyone see that? Underwriting Dno Claims?
Yeah.
We're seeing your notes. We're seeing not the presentation slide, but we're seeing.
All right, let me change the view.
Yep.
We like seeing your notes. We're gonna jot some of those down.
Well, there aren't any, I don't think. I'm gonna kind of go off the cuff here.
Yeah, I think it's the next slide we're seeing. So we're actually seeing both your slides, David.
Oh man, well you can't see that. You can't see it.
You can still
preview. You can preview the next one, yeah. I don't know how to. Well, in any event, you can see both of the slides. So is it all right if I just go off of this?
Yeah, that's
this odd view here. Okay.
Yes.
Well, great. Well, thank you for having me. My name is Dave Curtin. I am based in Boston. I am the private company product manager for the private nonprofit group within Financial Lines, which basically, is for the most part a single kind of product with complementary products. The Core Fund Portfolio 3.0 is the product that most of our business is written on. There's 9 cover sections on it. But within Financial Lines, we also have product managers for individual coverage lines across all divisions. Public company, private company, which is my group, not-for-profit, which is within my group, and then financial institutions and professional liability and things like that. So I would say on a day-to-day basis, my primary responsibility is private company D&O. With oversight, over our product that has all the other various coverages like employment practices and fiduciary and things like that. I've been, more or less underwriting private company D&O for about 15 years. Actually a little longer than that now. I started my career at Chubb, went over to ACE, and now I'm back at Chubb. And it's been great. So, we have a fairly limited amount of time here, but just a quick overview of kind of what we as D&O underwriters kind of look for, in total. And then also, you can see on the next slide there, we'll get into some specific financial kind of metrics or indicators that we look at when we're trying to assess whether a company is, in good shape, mediocre shape, bad shape, that sort of thing. And the reason that we do that is because bankruptcy is the #1 driver of D&O claims. So we as underwriters, D&O underwriters, we're really almost putting on a credit analysis hat when we're in the process of underwriting an account. And all the things that kind of go into that are, right, the actual financial performance of the company in the past, the projected future financial performance of the company in the future, their industry, what industry they operate in, kind of what are the macro effects on that industry, and where does our insured sit within that industry. And then we take a look at some other things that end up being triggers for D&O claims down the road, in enough frequency and with enough severity for us to really feel like they're important enough to pay attention to, like the ownership of a company. If a company is closely held with very few shareholders, there are common exclusions in the policy that sort of prevent the policy from covering like infighting claims between directors and officers and owners, if they're all the same party. But as you get into a more loosely held organization, maybe with venture capital backing, initial funding coming from angel investors, so you have an investor base of dozens or hundreds of small investors, some of which invested at different points in time and at different valuations, and you've got dilution issues and things like that. So that's kind of one thing we look at, and we view, the latter scenario as more risky than the former. And then you have like family ownership and things like that. And if the ownership of the family or the business is still within the first generation of family ownership, we view that as a slightly higher risk just because of family dynamics. And when you kind of get into third, fourth generation, where ownership of the company has transferred to heirs through hopefully a formal succession plan, but sometimes not, you end up with potentially, again, dozens or hundreds of family members that all own a piece of the company, many of whom have no direct involvement in the company, but they have an expectation of, distributions or dividend payments every year. And obviously equity value of the company, and when the company performs poorly, it could lead to claims from family members. We look at organizational structure. We try to understand our insured organizations as best as possible in totality. Right? The way our policies work is we write, essentially the top co, whether it's a holding company or a true kind of just operating entity at the top of an organization, and then our policy kind of flows down from there, where the coverage automatically includes subsidiaries that are more than 50% owned by our parent organization, that org that's on item 1 of the deck page. And we try to understand the financial kind of situation, the financial health of every entity that we're covering under the policy. There's a balance between how far we can dig and kind of what we're actually risking in terms of limits and things like that, just the time it takes and the information exchange that needs to occur relative to, let's say, the premium. The vast majority of our business is small account business in terms of policy count. So on a day-to-day basis, our underwriters are underwriting, small, middle market companies. It's much more transactional. You're doing a very quick, look at all of these things: ownership, org structure, financials. You're using models that we've created that kind of guide in underwriters to the premium that we feel, the model premium that makes sense, and then we try to find that deal. As you increase in complexity, revenue size into the $1 billion plus range, which we have in private companies, with many of those, the level of underwriting, the depth of underwriting, and the information exchange, hopefully, is much more robust than it is on the smaller account business. We do look at M&A activity, whether the M&A actually occurs, and perhaps there's some post-M&A friction, either with former and current owners or former and current employees. We view that as a risk, a risk event, an event risk. And then previous litigation, it's no certainty, but we do believe that there's a decent amount of predictability in terms of a company's past litigation history. If they've engaged in significant litigation, we feel it's more likely they will experience litigation in the future. And given that D&O is a liability coverage section, where in many cases we have a duty to defend the organization for any covered claim in total, we obviously try to write risks that are not going to have any litigation ideally, but we try to use our models to predict those insureds and those companies that are going to or more likely to have litigation in the future. When we say litigation, I mean it could be anything from employment-related litigation, so from within the company, or investor litigation. It could be third-party litigation, right? So disputes over contracts with vendors or third parties, customer complaints. Sometimes they end up coming in as almost like consumer protection type actions against the organization, and depending on how that claim is brought, there may be coverage for it under a D&O policy. So these are really the main things that we're looking at, on the vast majority of risks that come into us, as broadly. But as I mentioned up front, we are by and large credit analysts. There are so many things that a company and some of those other kind of exposure items that I mentioned that are extremely difficult to sort of dig out to assess. We do get applications in many cases, and we do ask questions about that. But by and large, we feel the thing that is the most in our control is our ability to underwrite the financial health of an organization and whether that organization is likely to go bankrupt. We're obviously operating in a time of great uncertainty right now, but let's assume for a moment that we are operating in a normal economic environment. Right? So we're mainly looking, we ask our underwriters to look at ratios. We want them to look at liquidity. We want them to look at leverage, and we want them to look at profitability, right? So when we're talking about liquidity, right, we're talking about cash. Cash is king. You know, again, going back to the current environment, we would love to see our insured with enough cash that would sort of act as an emergency fund, or allow them to invest in the business or grow the business. So cash is king. You know, we look at current ratio. Primarily, we ask our underwriters to evaluate the current ratio on every risk in their analysis. Right, so we're looking at basically current assets divided by current liabilities. We want to see a ratio above 1.0. You know, for the vast majority of industries. I mean, there are exceptions to that, but that's basically what we're looking at. So we're looking at current assets over current liabilities. On the asset side of a balance sheet, we are looking at intangible assets and goodwill. Right, we're trying to determine, right, how much of that company's balance sheet represents tangible assets that can be converted into cash, whether short-term or long-term, and how much of their balance sheet is composed of intangible assets and goodwill, right? The sort of, you know, the value of a brand name or customer relationships, you know, may not necessarily carry through in a bankruptcy proceeding or a sale of the company that would allow the investors to, at the very minimum, you know, recoup their investment in the company. I mentioned leverage ratios, right? So we look at the level of indebtedness of the company in relation to their capital base, whether that's assets or, you know, occasionally we'll look at, you know, long-term debt to equity. With the increasing frequency and the prevalence of private equity, the structures of a lot of like leveraged buyout transactions kind of throw a lot of our preferred debt ratio benchmarks to look a little out of whack. But you know, we adjust to that, and we sort of, instead of looking at the debt ratio, the leverage ratio, we're really looking at how indebted is this company relative to the value of the company. We try to look at it the way that the private equity firm kind of looks at the structure of the company, which is that can the EBITDA, can the operating income, right, support the debt load, the servicing of the debt that is on the balance sheet. Okay, and yeah, go ahead.
David, we have a question from one of the participants, and let me read it to you.
Great.
It says, with COVID-19, we have seen an increase in underwriting questions from carriers that previously were not asked. Do you see this as the new normal from the underwriting perspective for Dno? And then it follow-ups with the following. Will appetite be shrinking and prep time for submission to underwriters increase from 3 months to 4 to 5 months out?
Okay, so we have a COVID question, and then we have an information question. They're sort of related, right? So obviously, in the current environment, we're operating in a zone of significant uncertainty, right? So in the past, we've been able to kind of use past financial performance to predict future performance, but because we're in an environment that is so difficult to predict and so right, just out of the ordinary, we are finding ourselves as Dno underwriters and credit analysts having to predict a future in an environment that, you know, we haven't really had to make predictions in before. So instead of, I mean, we're able to glean a significant amount of information about a company, how it operates, what are the expected margins? Is the company growing? Is it stable? Is it shrinking? We're able to determine all of that in a normal environment from looking at past results. We are in an environment now where, I mean, it's not necessarily, it's a much smaller piece, I guess, of the underwriting process now, because we can't necessarily rely on the past information. We have to understand an insured the specific effect that the pandemic has had on an insured specifically because we have to understand a lot more about the operation itself than we normally would. I think speaking for Chubb, we try to get out as far in advance as we possibly can in order to facilitate the information exchange that's going to need to happen, because we are going to need more information. We are still trying to figure out what the right amount of information is and what the right questions are. And we're also taking it, industry by industry, where it makes sense, right? We have energy prices in, at unprecedented levels. So we're handling energy in a specific way under our energy business. Retail and real estate, those industries have been hurt. But what if it's a retailer that had a significant online presence and logistic and delivery network that could result in as much or possibly more business in this situation. So we are trying to take it on a risk-by-risk basis. We are probably going to ask more information just because of the uncertainty of the environment that we're operating in.
Hey,
in terms of the new normal. Yeah, go ahead.
I'm sorry, I was going to say, this is Kathleen. Part of Nick's question was really about that time frame, and obviously you're going to need more, you're going to have potentially more questions, but given the fluidness of the situation, are we looking at 4 to 5 months out that you all need to be getting submissions? If you don't mind speaking to the time frame, and maybe it varies by industry group, if you could kind of address that, I think it'd be helpful for folks to hear.
Sure. I would say our standard renewal process begins 120 days before the effective date of the renewal. That's the standard process. That doesn't necessarily mean that, your local underwriter or the underwriter that you work with at Chubb is going to send you something 120 days out. Everyone, especially now, has various responsibilities and book size, and it may not necessarily jive with your particular underwriting, your particular schedule with your whoever you're working with on your side. So I think there's a balance between making sure that we're out ahead of things and not surprising people with our information needs, with also trying to get as close to that renewal to that effective date as possible, because the closer you get to the renewal date, the more I think the more accurate and applicable the information you're going to get from the client is. I would imagine it'd be extremely difficult right now to ask the client what, if their renewal is 6 months from now, right? Their November, December effective date. I think it'd be extremely difficult to ask an insured now what their plan is for 2021. Unless they had a lot of clarity as to how things were going to shake out, either within their industry or not. I would say, if you have insureds in the real estate, retail, energy, hospitality, tourism, any of the industries that have been specifically and greatly impacted by the quarantine that's been going on, then I would say, earlier is better than later. And, from what I've observed, just both internally and in the marketplace, there does seem to be some behavior, and, I can speak for some of our accounts. We are trying to be prudent with limits management and capacity. I think that's kind of what you need to do, in a situation like this, where you're trying to balance between being there for your client, and also making sure that you are going to hopefully maintain a healthy book of business or a healthy business. That's what we're thinking about in private company and trying to balance those things. So just in terms of how far out, I can't really give you specific guidance on that. I can say that if you have questions about a specific insurer, to work with your local underwriter on timing, or broker, or whoever it might be, whoever you're working with, and you have an insurer that is in an industry that's particularly affected, those are the ones you probably want to be earlier on rather than later. There are many industries that have transitioned pretty seamlessly into a remote work environment, like tech, certainly in certain sectors of healthcare. There's been a lot of economic activity and haven't really slowed down much there either. So it does seem to be pretty industry specific at this point, but as we look around the country, we're seeing certain states open up, and so perhaps in November or December, things are going to look closer to normal than they are today, but I think it would be difficult for me to predict, because I've never been in this situation before. But I would just say, if you have an insured that you feel is in an industry that's higher risk, getting the most amount of information the soonest you can is the best course to take, because if by chance you are going to have a situation where the carrier or carriers that are involved in a program aren't comfortable with the current capacity or aren't comfortable extending any capacity, there will need to be a marketing of that risk, I imagine. And the other carriers that are writing business, I would include ourselves, we are still writing business, they're going to need that information too. And it's a matter of whether that carrier is comfortable with that information and comfortable with that risk or not. It's a good question. It's a tough question to answer. Happy to, take another, to go further offline if anyone wants to discuss. Be happy to do that.
Good. We do have two more questions for you right now.
Sure.
So one more question is, with a lot of companies being pre-revenue, like biotech, that receive some type of investment, what can they do to position themselves in the marketplace?
Biotechs and things like that. So, it's interesting, right? There's let's assume for a second to biotech, which I think the vast majority are funded through venture capital. Venture capital investors, there's an understanding that 8 or 9 out of 10 of their investments will fail, but they're in it for the 1 out of 10 that becomes a home run. I think if the investors see value in continuing the work of that biotech, I don't necessarily view it as something, a risk that, we wouldn't want to take from a Dno perspective. I wouldn't say our view has changed. If that biotech is specifically involved in, research and they've been getting funding from the government or something like that, that's kind of how they're modeled. We'd probably take a look at where the grants are coming from, how much money is left. And then if they're involved in clinical trials, that's another kind of component for the underwriting is, right, can they even conduct clinical trials? If they can't, are investors going to continue to, pay the employees, keep the lights on and things like that? As everyone kind of, in some cases anyway, is looking to sort of hoard capital and preserve capital where possible. What does that mean for the company? But I would say, again, it's very risk specific. It's very company specific. And so I think it's difficult for me to say, broadly. outside of kind of those examples that I mentioned, how a biotech would, I think, would be able to differentiate itself. I think was that the question?
Yeah. So the next question is, Marsh recently released a report stating that Dno rates were up 44% in Q1 and Q2. Is trending to double that. So, sorry, let me reread that. Marsh recently released a report stating that Dno rates were up 44% in Q1 and Q2, is trending to double that. Tesla recently released a publicly filing that they were not renewing the Dno and that Elon Musk will be offering his own equivalent of Dno. Are these price increases similar to what you are seeing?
Right, Tesla is a public company, and public company directors and officers liability insurance covers securities claims, and for the past it's been many years now, the number of securities class actions has increased. The awards in securities class actions have increased significantly, and the rates did not keep up in the public company space. And so public company directors and officers carriers, at some point the pain becomes too much and you need to start charging more for the risk you take. And that sort of has been happening over the past, 12 to 18 months. And I would say that those numbers, the 40% numbers, are, from my understanding, kind of where things are in the public company directors and officers marketplace right now from a carrier perspective. In the private company space, we cover significantly more than securities class actions, but the severity of our claims aren't nearly as significant as in public company, where companies may buy hundreds of millions of dollars of insurance and may actually end up exceeding that in terms of some of the award amounts that we've seen, especially on larger companies. So yes, on public company, that sounds about right. On private company, we have had a hardening of the market, and I would say the rates on average are probably right around the double digits at this point on private company D&O in total. In terms of Tesla itself, obviously Tesla is a very interesting company for many reasons. They have a very visible CEO. They are operating in an industry that is disrupting a enormous industry using technology that is new. And at some point, I think a company needs to undergo their standard risk management process and figure out if they are better off transferring the risk to an insurance policy or retaining the risk themselves. So sometimes you don't have a choice. And I believe that was the case with Tesla, where they couldn't find carriers to offer the capacity that they needed. So Musk gave the other directors and officers a personal guarantee of some kind. And you have to ask yourself, would you be willing to sit on Tesla's board knowing that if you were to be sued individually, that Musk would indemnify you essentially. It's a very unique situation, and I haven't heard of that happening very much. There is capacity out there. There's I think still plenty of capacity out there, but carriers are asking insureds to pay more for the risk they take. Until we reach a point where insureds don't want to pay it anymore, we'll have to look at other things in the balance. The coverage that's offered, perhaps to scale back the coverage. Everything's a balance. So I think the capacity will be there. There's a lot of capacity in the industry right now. It's the appetite and whether carriers want to deploy that capacity for the risk that exists and the premium that insureds want to pay or they expect to pay for this coverage. I would say it's been eye-opening for a lot of public company insureds and agents and brokers in the past year or so to see, increases of this magnitude. It doesn't happen that often in management liability, in my experience.
Okay, great. And I know it's harder to see the comments when you're presenting, but they're saying thank you for your answers. So you can continue. And David Sam, I don't know if you want to do a time check. I don't know how much more time we have.
Thanks, Max. Yeah, we're probably about ready to wrap it up. David, they're running simulated companies, and they're essentially acting as their own Elon Musk in their own management capacities.
All right. Well, good luck to you.
Hey, Dave, we just want to say thanks for joining us. And if you don't mind, if anybody has some questions, if we could share your contact information.
Absolutely. Happy to do that.
Thank you. We really appreciate you sharing part of your day with us.